Hey, what's going on, everybody? It's Crunch Time Trades here. I want to do a quick breakdown on auction market theory and how auction market theory applies in trading and in volume profile trading specifically. So, auction market theory is the theory that every index, every stock, all the things that you trade, the commodities, all of them trade like an auction, right? And so buyers and sellers are constantly making decisions about where to buy and sell based on their own perceived value of whatever it is they have. So in the market, there are places where value is formed, a price or range of prices where buyers and sellers meet consistently is considered value. So let's use an example and imagine that you are a fisherman. And as a fisherman, you go to the ocean, you catch as many fish as you can, and you come back to your town and you sell those fish. You bring those fish to the market where the auction takes place. So in this auction, in this market, most of the fish are sold at $6. The highest price fish sold was $10, and the lowest price was $2. And the prices fluctuate between where buyers and sellers are meeting, but the most common price where value is established is $6. And so as the price goes to extremes, you could imagine there would be less transactions happening. So less sellers would be willing to sell their fish at $2 as opposed to waiting for the price to reach value of $6. Now, the same goes for a buyer. A buyer would be very unwilling to buy at $10, where what we would consider a premium, right? If you think about where the prices are and where value is at $6 and the premium is 10 and the discount is 2. And so we always want to buy at the discount and sell at the premium, right? But on the flip side, as the seller, you don't want to sell at discount, right? So you wouldn't want to make an agreement with a buyer at discount, right? When you could potentially sell at fair value or the perceived value, or a premium where you could get more money for that fish that you sold. On the flip side, as a buyer, you would never want to buy at premium, right? When you could potentially buy at value or a discount. That makes sense? And that's how an auction works. And so that's why buyers and sellers are always typically coming to the center, wherever value is, and establishing a point of value. Now, as we get into the two reasons why price may escape value or move away from value and discover new value, we're talking about an information change or a circumstance change. And so the first example, a circumstance change. What if the fisherman needs to sell his fish in the next 20 minutes, right? He gets back off the boat a little late. He knows that he's got to get back to his house to tend to his cattle or his house or whatever he has to do, right? He has to leave. And so he has to sell those fish that he got on his boat as fast as possible. And so that changes his circumstance. He needs to sell them faster, and he's not as worried about getting fair value or potentially premiums when he sells those fish. So he may sell the fish at discounts to get them off his hands, right? And so that's a circumstance change that might force value or price to change from person to person. Information also causes value to change, and this can cause more drastic shifts. So information, right? What if the fish keep making people in the town sick? This information would cause the price to leave its current value area and discover new value. So now that less people are wanting fish because they don't want to get sick, the average price comes down to $3 per fish. And maybe a low price is set at $1 and a high price is set at $5. The value is now shifted in the market, right, due to new information. And in that new auction where the new information is present, value is reestablished at $3. And so that's how new information can force value to shift and discover new value in the auction. All right, let's jump on the charts and try and apply auction market theory to the charts. So we're looking at MES here, which is our S&P futures. And Today, this is price action from earlier today, Thursday, and you can see price is just moving up and down within our value range. And so when we look at where most of the volume took place in the market, right, about here, which pretty well puts together our value area low, our value area high, and our point of control, right? They all fall within where the most transactions occurred in the market. And you can see in the volume profile, right? This is our volume profile, illustrating where the most volume took place, or where volume took place at each price. As you move down to a further and further discounts, there was less and less transactions happening. Same thing at the top, right? We opened up here and price instantly pushed us down, go to where value was wanting to be established in the market. And so there's not a lot of transactions happening up here either, right? The majority of transactions occurred between our value area low and our value area high. And when we look at our point of control, right, not a great point of control when you consider that there are a lot of points within this high volume node that have a ton of volume, but this was a significant or a particular spike in volume as far as price where transactions are occurring that was notable, and this was considered the highest point of volume. So this is our point of control. And without new information, we often expect price to move like this through our different premiums, down to discounts, to the point of control, back to discount, up to premium, right? It's no significant, or like no particular science how this moves, but you can see how it typically stays within this range. And so how can we trade this? This is on the 1 minute time frame. So it's not like a higher time frame trend, but what we're looking at is if we can see multiple times where our value area low is being respected and pushing back up, when we tap that value area low again, we should look for longs. We should look to play it back to the point of control where the most transactions happen, right? Where most value is established, and even our premium price, right? If we're expecting price to move through those zones, you can expect, hey, I'll take a long, I'll buy at the discount, and I'll try and sell at fair value and premium, right? And I'll make my profits there. On the flip side, I'll sell at the premium, right? Selling at the top, and I'll buy it back at value or discount. So if we were going to apply this and take a trade off of this, look for longs here. Actually, let's take a short first. So we can see a bunch of times that we bought up to our value area high and sold back to our discount price and our control, right? So this happens 4 or 5 times, 6 times throughout the session, right? And so if I'm looking and price is starting to get up towards our value area high, I also have, other points of interest from the previous sessions, but we'll get into that later, how that makes the entry better. But I'll take my entry right at the value area high. I'll put stops maybe at or maybe above, where some more of this value is, right? Because we see like there's a little bit of a high volume node here and some volume starts to taper off as you get down here. So we can assume that maybe we'll play, behind some of this volume right here, right? So 7-point stop, and I can take this position all the way down to where we assume value is. Market. We don't assume it. We know value has been established in the market here. This is where the most transactions are occurring. Great. And so we can play this short. Really good RR on this trade just because of where value had been established. But like, even if we're going to take maybe some partials at this first high volume node, take some more partials at this high volume node, and then take our last take profit at this highest volume, that could make sense. Again, if we're trying to play our longs, we can see this here. Oh, okay. Well, we got we didn't tap our value area low here, so we did tap our control, but let's just wait. Okay, we get our value area low here, entry on that. Maybe we'll put stops, back here, maybe 4 points, and then we would probably honestly just target the point of control at this point, especially as volume is decreasing later in the session. Yeah, we could target the point of control, and then we could set runners for the premium price or runners for another high volume node throughout the value range. So maybe here might be one. Maybe would have got filled, maybe not. And then we could set our final TP at our value area high. So and that wouldn't have played out all the way, but right, you still get your partials at the point of control and moving stops up, and so you got potential upside for more, even though it didn't come. But that's the general idea of how we can trade auction market theory in the markets by using a volume profile. If you like this video, be sure to leave a like, comment questions that you may have about auction market theory and applying it to your trading. And if you haven't already, please do subscribe. With that being said, I'll catch you guys in the next one.